how the wealthiest people in America manage to pay so little in taxes compared to the average worker? It's not just about secret bank accounts. It's about a system designed to tax what you do, not what you own. Today, we're breaking down the mechanics of the tax code and the strategies that keep the ultra-rich, well, rich. Meet two people. One earns a salary of $100,000. The other owns $1 billion in stocks. The worker pays income tax on every dollar. The billionaire might pay nothing at all. Let's find out why. Most of us live in the world of income tax. This is a tax on labor, the hours you spend working. The top federal income tax rate is 37%. That's a significant chunk of a high earner's paycheck. Wealthy individuals, however, build their fortunes through assets, stocks, real estate, and private businesses that grow in value over time. This growth is called an unrealized gain. As long as they don't sell the asset, the IRS doesn't touch it. If they do decide to sell, they don't pay the high income tax rate. Instead, they pay capital gains tax. For assets held over a year, the long-term capital gains rate tops out at just 20%. That's nearly half the rate of the highest income bracket. It's a massive head start for those living off investments. But what if they never sell? This brings us to the most famous strategy in wealth management: buy, borrow, die. Step 1 is buy. The wealthy acquire assets that appreciate, meaning they get more valuable every single year. Think of a tech founder whose stock goes from $1 to $1,000. That's billions in growth. But everyone needs cash to live. If the founder sells stock for cash, they trigger that capital gains tax. So they move to step 2, borrow. Instead of selling, they go to a bank and take out a massive loan. They use their stock as collateral. The bank is happy to lend because the billionaire is a safe bet. Here is the trick. The IRS does not consider a loan to be income. Therefore, the money is tax-free. The billionaire uses this tax-free cash to buy houses, yachts, or even more investments, while paying very low interest. Their assets often grow faster than the interest on the loan, making the strategy a cycle of endless, tax-free wealth. Eventually, everyone reaches the end. This is step 3, die. And this is where the biggest loophole of all exists. It's called the step-up in basis. When an heir inherits an asset, the taxable value resets to the current market price. If the founder bought stock at $1 and it's worth $1,000 when they die, the capital gains vanish. The heirs can sell the stock immediately and pay zero tax on decades of growth. The cycle resets for the next generation. Beyond buy, borrow, die, there are countless other tools. Real estate investors love a concept called depreciation. On paper, they claim their buildings are wearing out and losing value, which they use to cancel out their actual income. In reality, the property is likely becoming more valuable. It's a phantom loss that creates very real tax savings. Then there are pass-through entities like LLCs. These allow business owners to shift personal expenses into business deductions. Charitable foundations also play a role, offering massive deductions while allowing families to maintain control over the funds. The result is a tax system that looks very different depending on whether you work for money or your money works for you. Proponents argue this encourages the investment that fuels innovation and job creation across the entire United States. Critics argue it hollows out the middle class and creates a permanent aristocracy that is disconnected from the tax burden. Regardless of your stance, understanding these mechanisms is vital for anyone interested in the future of our economy. Is the system broken? Or is it working exactly as intended? That's the debate currently shaping modern social policy. Thanks for watching this deep dive. If you learned something new, hit that like button and subscribe for more finance content.